Terrific stuff. Thanks very much for that, Russ. So I've been introduced as Craig Baker, the Global CIO at WTW. That's true, but perhaps more importantly for this presentation, I chair the group of three that manage Alliance Trust on a day-to-day basis, so alongside Mark Davis and Stuart Gray. So you could have had any of the three of us giving this presentation. You drew the short straw. You've got me for today. I brought the slides up with me. Hopefully I won't need to use them, but last time I gave a presentation, both screens went completely dead and I couldn't see anything. So just on that off chance, I've got them here. So what's the objective of the trust? What are we trying to achieve? Well, ultimately, it's all about trying over the long term to produce returns well in excess of inflation through patient investing, but to do that through a combination of both capital growth and a rising dividend. So that's important. Now, our view is that if we achieve that objective over the long term, that will ultimately lead to significant outperformance both of our benchmark index, which is the MSCI All Country World Index, and the peer group as well. So how do we do that? Well, ultimately, Alliance Trust is a global equity multi-manager approach. So what we do is we pick who we think are the world's best stock pickers, and we ask them to just give us their very best ideas, up to 20 stocks, but just their best ideas in a portfolio specifically designed for Alliance Trust. So Russ gave you a big explanation of why it's so difficult to call macro factors. We don't try. Ours is all about bottom-up stock selection, partly for that very reason. We at WTW manage the trust, so what we do is we go out and we find who those best stock pickers in the world are. We decide how much to give each of those stock pickers at any point in time, taking into account the risk of the portfolio. We try and ensure that stock selection is driving everything, take out all of the big risks from macro events. And then if we have to, we'll change the managers at a particular point in time. So what kind of advantages does that lead to in the trust? Well, first of all, you get conviction. So every single stock in this portfolio is one of the stock pickers' very best ideas. But secondly, because we blend 10 managers together, you do still end up with a diversified portfolio. So it's not just one or two stocks, and it's not just one individual's idea following one particular view on markets, given a lot of the things we've just heard about. Thirdly, we can do that with competitive costs. One of the problems with multi-manager often is that there's that double layer of fees. It can work out as pretty expensive. Because WTW has an enormous client base, we've got clients that amount to about $4 trillion of capital that we advise on, 200 billion that we manage. We have pretty good bargaining power with the asset management community, and we've ended up with an OCR on this trust that is less than most single manager trusts, let alone multi-manager approaches. Exclusive access. So we're actually bringing managers to this, stock pickers, that often don't even manage assets in the UK, don't manage assets in retail. We're just finding the best managers from wherever they are in the world. And in fact, even the ones that do run money in UK retail some other way, you can't access their 20 stock best idea portfolio anywhere other than via Alliance Trust. We make sure that sustainability is a part of what we do and embedded in our investment process, and we do that for financial reasons. We think it's going to get better returns at lower risk. And finally, we do it in such a way that the board can continue to deliver the 57 years of uninterrupted dividend increases on the trust. So let's start with why we think multi-manager is important. I've got this chart on the right-hand side, which might look complicated. It's actually very simple. What it's saying is, if you start with all the top quartile managers in one 3-year period, so on the left-hand side, the 2003 to 2005 period, who were the top quartile managers? What proportion of them then were top quartile again in 2006, 2008? The answer is 30%. And then what proportion were also top quartile in 2009, 2011? It's now 3%, and it starts going to 0. And if you actually take the later periods, it goes virtually to zero immediately because of that flip on the value growth phenomenon in markets. And so the point is there's very little persistency if you're picking single manager approaches. And so if you want to have a comfortable journey along the way, and investing is as much about the journey as it is the destination, then you really have multi-manager as an attractive way of doing that. Now, you can try and do that yourself, investing in lots of different investment trusts. But what Alliance Trust does is it does that for you with an enormous research team that can get access to managers that don't even run investment trusts and do it all within the trust so you're not paying capital gains tax every time you have to rebalance. Now, multi-manager, one of the other issues that I mentioned, costs that we've been able to address. One of the others is potentially you could end up over-diversified. We've addressed that by just saying we only want your best ideas. So partly that's so that we don't end up over-diversified. We can still outperform significantly. But part of it is because you're actually structurally better set up for success if you just take people's very best ideas. And we've got evidence of doing that for nearly 20 years running money this way. But actually, there's a lot of academic work out there that proves this phenomenon as well. I've stuck up a chart from one of those. I could have picked a multitude of different surveys. But what this did is it just took all of the equity managers out there, and it said, let's rank them by decile, by how much risk they take relative to the benchmark. So on the left-hand side, you've got the closet index trackers that own most of the stocks in the benchmark. On the right-hand side, you've got the ones that take a lot of risk relative to benchmark. They run really concentrated portfolios. Let's call them 20-stock portfolios that end up in the Alliance Trust portfolio. And what you see is if you literally just randomly throw darts at people that run concentrated portfolios, they significantly outperform others. Now, we don't do that. We then pick the ones that we think are the best stock pickers, and we have an enormous research team to do that. But we're fishing in an attractive pond. Now, why is this phenomenon true? Well, it's not that difficult if you think about it. What actually happens is that half of managers on average outperform, half underperform versus the benchmark. That's by definition. But interestingly, the vast majority of managers actually outperform in their largest overweight positions and then destroy value in the rest of their portfolio. And that's because individuals, good portfolio managers, are really only going to have really high conviction in a small number of things that they know better than everyone else. It's very difficult in the rest of the portfolio. A lot of the things that are in there are for risk control purposes. Because markets are efficient, they tend to actually produce negative returns. So Alliance Trust, very simple. We just go to those best stock pickers, say, only want your best ideas. We'll worry about risk in how we blend them. You end up with a better outcome. Well, okay, but how do we pick those great stock pickers from anywhere around the world? Well, the simple thing is we just have an enormous research team. That's all they do all day. So we research all of the products that are out there, and we look for great stock pickers. We find individuals that have been very successful over the years, have been through multiple market cycles, and we look for ones that are in a stable organization that's investment-led, where they've got interests aligned with you and with us. So here's the lineup of stock pickers that we have in the portfolio as of today. The two that are sort of highlighted with the edges coming out of the pie chart, Dalton and ARGA, are simply highlighted because they're the two that have come in the last 12 months. Dalton at the back end of 2023 and ARGA in the last few weeks. Just as you go around that, I can sort of bring to life how they're very different. And that's the whole point of this. We want to find world's greatest stock pickers, but make sure we pick the ones that just think differently to each other so you get genuine diversification and we don't have some of these macro bets in the portfolio that were alluded to before. So we start off top right. Let's start Black Creek. They're based in Toronto. They're kind of a value manager, but they tend to be looking for market leaders in niche sectors that have become undervalued, haven't been looked at for a long time. They will look quite different from others. They've got nothing in the so-called Magnificent Seven, the big US tech companies that have been driving markets in recent times. They're overweight Japan. They're a bit different to some others. Then down to GQG. This is based in Fort Lauderdale in Florida. Global quality growth is what they've defined as. They're looking for companies that they define as quality and growth, but around quality of the cash flows of the business. So they won't always be in growth sectors that are typically known as growth sectors. There'll be times where there'll be traditional value sectors that have got really strong cash flows at any point in time, and they'll be in those. Arga, one of the newest ones, they came in the last few weeks to replace Ben Whitmore at Jupiter, who's leaving in the summer. Arga, run by Rama Krishna. We've been researching Rama for about 25 years. I personally was researching him in emerging markets when he was at Citigroup 25 years ago. He has been a value manager in global equities and emerging markets for 30 years plus. They came into the portfolio quite recently. Lyrical, New York value-based manager, a bit more biased on US mid-caps. Metropolis in Amersham, of all places, so more of a quality value manager as well. Sands, out-and-out growth manager in the US. Sustainable Growth Advisors, much more high-quality compounders of companies that are producing strong cash flows and got a moat, essentially. Veritas, London-based, more value and quality. Vulcan Value Partners, very different, based in Birmingham, Alabama, and they think more Buffett-like. And then finally, Dalton, a Japanese specialist, and we took advantage there of some reforms in Japan that are actually making it much more shareholder-friendly, reforms driven by both the government and the Tokyo Stock Exchange. They're a mid-cap specialist that are able to invest in companies that look very cheap and are aligned to shareholder interests. So that just gives you a feel for how different some of these managers are, where they're based all around the world, most of them not known in UK retail space at all. That's some of the strength that we're bringing as an investment in Alliance Trust. Fine, but has it worked? Have we been able to produce good performance, but also that comfortable journey along the way? Well, up here we've got the typical 3- and 5-year numbers that were out of the last annual report. And you can see that actually if we define risk as volatility, of course that's not the only way to look at risk, not always the best way to look at risk, but nonetheless it does play to this comfortable journey along the way. There's, in 3-year period, been no one in the global equity investment trust sector that's produced lower volatility, and yet it's been about the best performing trust across the piece, averaging, doing better than the average by nearly 10% per annum over that 3-year period, and better than the index, which has done incredibly well because it's been driven by a small number of US large cap tech stocks. Similarly, good results over the 5-year period as well. And if we look at the entire 7 years that we've been running the trust, a tough period for bottom-up stock pickers, given that markets have been driven by some big macro factors and less so from the fundamentals of companies for some of that period, you can see that the story still holds. Don't worry, I'm not going to go through this slide. It's there for the detailed among you when we send the slides round later. This just gives you the detail over various periods against various different benchmarks and the like. We've outperformed all of them over 1, 3, 5, and 7 years and produced upper quartile results. This one, again, is a bit detailed, and you can peruse this at your leisure. It's actually just there to show you that it's quite boring. So what this is it looks at our portfolio from a top-down perspective and says, how does it look relative to the benchmark, the MSCI All Country World Index that's made up of a few thousand companies listed around the world? How does it look? And it looks pretty similar. It doesn't run big style biases relative to the index. It doesn't take big geography positions relative to the index. It doesn't take big industry sector positions. Back to this point that we don't think we or most people are great at calling the macro side, and we want stock selection to drive everything. The portfolio looks completely different to the index on a stock-specific basis, less so at a top-down. And these are the kind of tools we're using when managing the risk and deciding the weightings between the different managers. The one thing that does stand out, far left in the top chart that you might not even be able to see is that one strategic bet that we do tend to have is we're slightly underweight mega cap and large cap. If you're setting people to find their 20 best ideas in the world out of a universe of a few thousand, it's unusual for them to be overweight all of the biggest ones that have gone up the most and are the most covered by the brokerage community. And given that, we tend to actually be underweight those mega caps, and we've been underweight the ones on the right-hand side that make up the benchmark as of today. We've been underweight that Magnificent Seven for most of that 7-year period we've been running it. We're about as underweight as we've been at any point today, and that's been a real headwind. That's been tough on us. That's hurt performance. We've still managed to significantly outperform, which shows that stock selection has been particularly good. But that is something to bear in mind. Now, one of the things we often get asked is, well, how do you feel comfortable being underweight those 7 stocks that continue to drive the market? They look fundamentally great companies. They're producing really good cash flows. These are not like the growth companies of the dot-com bubble where they weren't producing earnings. Quite right, they are good companies. The question is more whether that's reflected in their valuation or not. And we just point out that there's been this huge level of concentration before in previous decades. We're going back here quite a few decades to show it. The interesting bit is it's very rarely been the same companies, or even 1 or 2 of those companies, that have been in the top 10 list a decade later. Maybe that's going to be true in 10 years' time. And that's why, rather than talking about the Magnificent Seven that make up the benchmark, we tend to talk about the modest many that make up our portfolio. And so we're looking for companies where the fundamentals of those companies are improving and doing really well and beating expectations, but that hasn't yet been reflected in the share price. So just for a nice slide for this group, we asked each of our stock pickers to give us an example of a company that they own in the portfolio that has been delivering fantastic earnings progression, but the market doesn't seem to have reflected that in their share price yet. And so here's just a few of those. As you can see, they're not necessarily the well-known names that you're hearing about, the Magnificent Seven and the like, but maybe 1 or 2 of these will be in that list of top 10 at some point in the future, who knows. But that's the kind of thing that we're expecting from our stock pickers. Just a nod to dividends. As I said before, the trust has managed to now, as of 2023, have 57 years in a row of increases in dividends. Luckily, we have huge reserves in the trust. We feel very confident that will continue for many years to come. I don't want to be in charge of the portfolio when they break that record. So that is something that continues in the trust. Maybe I'll just touch on what our outlook is. I've said we don't spend a lot of time thinking about the macro things. It's not totally true. We do spend a bit of time thinking about that. We challenge the managers on that. All of those stock pickers have to think about the macro outlook when thinking about the companies that they're investing in. They're not investing in isolation, in a vacuum. Things are happening to those companies. When we look at the portfolio today, we are extremely excited about it from a bottom-up perspective. I gave some example stocks on there, but there are lots of them. I can talk to the stock pickers about all of the stocks in their portfolio and why they can look at them and say, well, there's no way that the share price has fully reflected the fundamentals of that business yet. In fact, we've built tools that allow us to assess how much of the returns have come from each of those managers' portfolios from the fundamentals of the companies versus multiple expansion or contraction just on the valuation of those companies. And we get a lot more confidence in the former than the latter, because in the long term, it's the fundamentals, earnings progression that drives the stock market. In the short term, it can be the latter. So we're very excited from a bottom-up perspective, but we are cautious of the fact that markets have done incredibly well. There's a lot of macro risk around. Russ talked through some of those issues earlier. And so as a result, we reflect that a little bit in that the amount of gearing we've got in the portfolio is at the lower end of what we typically are. just to be clear, I've said this is all about stock selection, so we do not take big risks on gearing. On average, our 10% borrowing in the trust, we tend to be in the 7.5% to 12.5% range of gross gearing. We're just at the lower end of that. We don't want to swamp returns. Stock selection will drive everything. So, to summarize, performance has been strong, particularly in recent years. We continue to deliver a strong dividend that's growing every year. And we're really excited about the bottom-up parts of the portfolio as well. At that point, I'll hand over to the next speaker. I might have to go through a few slides.